Welcome to The Explainer. Today, we're tackling a puzzle that sits right at the heart of the investment world. We're told to think of bonds as fixed income. Sounds pretty stable, right? Safe, predictable. But if you've ever glanced at the market, you know that bond prices are anything but fixed. They're moving all the time. So what gives? How can something be fixed and constantly changing? Well, let's figure it out.
Okay, so let's dive right into this so-called fixed income puzzle. The name itself sets you up to expect one thing, but the market shows you something completely different. It's way more dynamic than it sounds. And this is the central question, isn't it? When a bond is created, its interest payments, what we call coupons, are set in stone. That part is fixed. A 6% coupon is always a 6% coupon. So why on earth does the price you can sell that bond for bounce around every single day? It really does feel like a contradiction, but once you crack this, you basically understand the entire bond market. The answer, believe it or not, comes down to a really simple but super powerful idea. I want you to picture a seesaw. On one end, you've got the bond's price, and on the other end, you have its yield.
This is it. This is the golden rule of bonds. You have to remember this. When market interest rates, the yield, go up, the price of the bonds you already own goes down. And when market rates fall, the price of your bonds goes up. They're locked in this constant inverse dance. One goes up, the other goes down. Always. So, why does that seesaw work? Well, here's the secret. A bond's price today isn't about what it paid in the past. It's all about the value of its future payments, all those coupons and the final payback, and what that stream of money is worth in today's dollars. This idea of present value is absolutely everything.
And this table shows that seesaw perfectly. Okay, imagine you're holding a bond that pays a nice 6% coupon. But then the market changes, and new bonds are only paying a 4% yield. All of a sudden, your 6% bond looks amazing, right? So people are willing to pay more than its face value to get their hands on it. That's a premium bond. But flip it. If new bonds start paying 8%, your little 6% bond isn't so attractive anymore, and its price will fall below face value. It's now a discount bond. It's all relative.
And just to get a little more advanced for a second, that seesaw doesn't move in a perfectly straight line. It's actually a curve. It's a concept called convexity, which basically just means that a 1% rate hike might not move the price by the exact same amount as a 1% rate cut. It's a little bit asymmetrical.
All right, so the theory is down. We get the seesaw. But now let's put some actual numbers on this thing and see how a bond's price gets calculated in the real world.
So how do you find that price? It's actually a pretty logical four-step recipe. First, you just map out all the money you're supposed to get in the future. Then, you figure out the current market interest rate, the yield, for similar bonds. Step 3, you take each of those future payments and you discount them to figure out what they're worth today. And finally, you just add it all up.
Let's look at an example. We've got a 4-year, $1,000 bond that pays a 6% coupon, so that's $60 a year. But let's say the current market yield is only 5%. Because of that difference, every single one of those future payments has to be discounted. $60 a year from now is only worth about $57 today. Why? Because a dollar tomorrow is always worth less than a dollar in your hand right now.
And when you do the math and add up all those discounted values, there's your price, $1,035.45. It's selling for more than its $1,000 face value, which makes it a premium bond, exactly what our seesaw table predicted. The lower market yield pushed that price up. See how it works?
Okay, so we know why prices move. But the next big question for any investor is, how much will they move? Is there a way we can measure a bond's sensitivity to all this?
You bet there is, and it's a super important idea called duration. Now, it's measured in years, but don't just think of it as time. The best way to think about duration is as a bond's risk meter. It tells you how sensitive that bond's price is to changes in interest rates.
And the rule here is incredibly simple. The bigger the duration number, the bigger the price swing you can expect when interest rates change. A bond with a high duration is way more volatile than a bond with a low duration. It's that straightforward. In fact, professionals use this quick back-of-the-envelope formula all the time. The percent change in a bond's price is going to be roughly its duration multiplied by whatever the change in yield is. So, if you have a bond with a duration of 4 and interest rates suddenly jump up by 1%, you can bet that bond's price is going to fall by about 4%. It's a really handy shortcut.
And this chart just nails the point home. Look at this. It's the exact same 1% rate hike hitting 3 different bonds. The bond with the 6-year duration, it gets slammed with a 6% price drop.
That is 3 times worse than the hit the 2-year duration bond takes. That's duration in action, plain and simple.
So once you understand this relationship between price, yield, and duration, you can really start to see the bigger picture. It lets you navigate the bond market with your eyes wide open.
And it's also really important to remember that, not all bonds are created equal. We've mostly been talking about your standard, plain vanilla fixed coupon bonds. But there's this huge universe out there. Bonds with no coupons, bonds whose coupons change, inflation-protected bonds, you name it. And all these concepts, especially duration, work a little differently for each one.
And all of this knowledge lets you decide what kind of investor you want to be. A passive investor might just say, hey, the market has priced this risk in, and I'll just hold it. But an active investor, they use this to try and get an edge. If they think rates are about to fall, they'll load up on long-duration bonds to maximize their gains. If they're worried rates are going up, they'll switch to short-duration bonds to protect their portfolio. It becomes a strategic tool.
So the next time you hear on the news that the Fed is thinking about changing interest rates, you won't just hear a headline. You'll actually be able to picture that seesaw starting to move, knowing exactly how that decision is affecting trillions of dollars in so-called fixed income investments. You'll get why their prices are truly anything but fixed.